Hey guys, it's Keith. Today I wanted to talk about something. I see a lot of people on Twitter and YouTube, and they talk about, oh my God, the Federal Reserve is printing money. That's so crazy. It's gonna go to like inflation, and it seems like a lot of people don't understand what that means. Like, what does it mean when the Federal Reserve prints money? And that's what I want to talk to you guys about in this video. Okay, to begin this, I'm gonna start at the top. Okay, so the Federal Reserve doesn't actually print money physically or digitally. That's not what they do, and that's not what they're in charge of. So why do people say this, right? So what the Federal Reserve does is they're in charge of monetary policy, they're in charge of quantitative easing, and they have a bunch of tools they can use to try and give confidence to the economy. And I'll explain to you how they do that. So what happened in the 2020 pandemic is that the Federal Reserve came out and started issuing banknotes, right? So this is like a form of quantitative easing, right? So then they issued a bunch of banknotes, and basically a banknote is an IOU letter. That's it. And they give these IOU letters to banks, to private banks like JP Morgan, Morgan Stanley, and right, or like the Royal Bank of Canada, any of these banks. Okay, and then so before I go on, I need to explain how the money printing system works, right? So at a bank, let's say I'm the bank, right, and you're coming to me to deposit $100. Okay, by law, I have to have 10% cash reserve at the bank. So you're coming and putting in $100 to your checking account in me, and person B, let's say, okay, person B comes and wants to get a loan from me, so I can give a loan of $90 to person B, all right? And then let's say you come back and you take your, like, out of the $100, let's say you take $90, you leave $10 there. What just happened? Right? Number one, you got $90 back from your checking account. You still have $10 in your checking account, and someone just has $90 loan. But then, technically speaking, I just printed money out of thin air. Not really, but I created money in the form of debt. Money is not free. It's not printed freely. It's distributed out in the form of debt. So by doing that, I just printed money. And the person who allowed me to do this more is the Federal Reserve. Now, let's talk about the cash reserve. I have a 10% cash reserve. That means I must have $10 here. Let's say you come back, you don't take $90, you actually take all $100. What happens? I gave out a loan for $90, and you came and you took your $100 back, right? So now I have no cash. So how do I cover up my 10% cash reserve, right? Because by law I have to have a 10% cash reserve, right, in the bank, since I'm the bank. So this is called the overnight lending market, or the repurchase agreement market, or the repo market. Okay, so what is that? So after the bank closes, essentially what happens is banks trade with each other. What do they trade? They trade securities like treasury bills, T-bills, tips, just a bunch of them, right? And basically they will trade whatever they need to fill their 10% cash reserve. And by borrowing this, they're paying an interest to the other bank. So this is like a quadrillion dollar market. This is crazy. And the reason this is allowed is because the securities are not leaving the banking system. They're staying within the banking system. Therefore, it's 100% legal. So by trading these overnight, I can keep the standard of the 10% cash reserve. And I'm distributing money. So the more banknotes the Federal Reserve issues out to banks, the more loans and mortgages and other like any type of like debt I can issue out to companies, businesses, and people. And that's essentially what money printing is. Why does this happen? Right? So when the economy is going down, one of the biggest things that's happening is there's less money circulation in the system, meaning less people are inclined to go out and buy things, right? So the theory is that by doing this and producing more debt, making debt more easily accessible for people and companies and businesses, they're going to be inclined to spend more money, which will inadvertently boost up the economy because there's more money in circulation. So this is how the Federal Reserve prints money. They don't actually print money. They issue out banknotes to allow the banks to produce more debt. Now, how is the stock market related to the economy? They're not. the stock market and the economy are not related at all. So then why does the stock market go up? Like on March 23rd in 2020, when the Federal Reserve announced that they were going to do quantitative easing and use all of their tools in their bag to support the economy, the stock market went up. So how can I say that the stock market is not correlated to the economy when it seems like it is? So think about it like this. This is how I like to explain it to people, right? Let's say I have a bunch of credit cards and I've been living a lavishing lifestyle and I've maxed out all my credit cards and then I panic. This is the stock market crash when I panic, right? And then my rich uncle comes over to me and says, hey, here's an IOU, right? Use this to get a bunch more credit cards to keep living the same lifestyle that you've been living. What am I going to do? I'm going to use that to get more credit cards and keep maxing them out. And I'm going to keep doing what I've been doing and spending money, and I'm not going to be changing anything at all. Right? So what did my uncle do? He just gave me confidence to keep doing what I'm doing, to not change anything. So the stock market and the economy are different, but the Federal Reserve gives so much confidence, right, back into the banks that and the system that everyone naturally spends more money. And where do they spend their money? On assets. What are stocks? Stocks are equities. Equities are assets, right? So this is why the stock market will go up, because there's more confidence in the people who trade stocks, right? Who want to buy stocks. And if you think about it, 80% or 70%, I'm not really sure what the number is, but majority of stocks are bought and held and sold by banks. That's why when there's a huge stock market crash, it's majority of people that are selling are usually these large corporations and banks, right? Because they want to protect their money. So this is how I like to explain how the Federal Reserve prints money. They don't physically print money. They're not allowed to print money. They help, or they allow banks to distribute more debt into the system to allow for more spending, right? The more spending there is, the more of a healthier economy there is. And that's how it works. So I hope you guys understood that. If I wasn't clear, just ask me questions. I'll try my best to clarify it in the comments below. I'll read all the comments, so don't worry about that. If you found this helpful, go ahead and subscribe. Give it a thumbs up too. Let me know, if you have any questions, just let me know. Thanks guys for listening. Stay safe.